When you hear the word expense, what comes to mind? Maybe paying rent, paying salaries, or paying the electricity bill. In many cases, an expense does involve paying cash. But here's something that surprises many beginners. Not every expense comes from paying cash. For example, imagine a business has been using the same laptop for years. No cash is being paid, but using that laptop still creates an expense over time. Or imagine a customer owes the business money it is unlikely to pay. No cash is leaving the business, yet an expense may still need to be recognized. These situations don't fit the 4 adjusting entries we've already learned. Instead, they belong to another group of adjusting entries called depreciation and bad debts. Today, we'll look at what they are and why they are needed. In the next few videos, we'll learn each one in detail. Let's start with the first one, depreciation. Depreciation is the systematic allocation of the cost of a tangible long-term asset over its useful life. That may sound technical, so let's simplify it. When a business buys a long-term asset, such as equipment, furniture, or a vehicle, that asset is expected to help the business for several years. Instead of recording the entire cost as an expense immediately, accounting spreads the cost over the periods that benefit from using the asset. In other words, part of the asset's cost becomes an expense in each accounting period. And this expense is called depreciation expense. In the next video, we'll learn exactly how depreciation is recorded and why it's considered an adjusting entry. Now let's look at another adjusting entry that recognizes a different type of expense, which is bad debts expense. What is bad debt anyway? Bad debts are estimated amounts of accounts receivable that are expected to be uncollectible. Sometimes a business sells goods or provides services on credit. This creates accounts receivable, which represents money that the customers owe the business. Although most customers pay, some may never do so. Instead of waiting until it's certain that the money won't be collected, accounting estimates the amount that is unlikely to be collected. And that estimated loss is recognized as bad debt expense through an adjusting entry. We'll learn how that estimate is made and how the journal entry works in a later lesson. By now, you've seen the most common adjusting entries you'll encounter in an introductory accounting course. The first 4 focus on recognizing revenues and expenses at the proper time. Depreciation and bad debts focus on recognizing expenses for different reasons. Together, these adjustments help ensure that revenues, expenses, assets, and liabilities are reported appropriately at the end of an accounting period. And that's it for this overview of other adjusting entries. I hope this lesson helped you understand what depreciation and bad debts are and why they're considered adjusting entries. If you have any questions, feel free to leave them in the comments. I'd be happy to help. In the next video, we'll focus on straight-line depreciation. You'll learn what it is, how it works, and how to calculate depreciation step by step using an easy example.